Trading of Apple shares was halted today after the stock suddenly plummeted nearly 10%. The plunge stemmed from technical problems at Bats Global Market. Coincidentally, the third largest U.S. exchange was scheduled to begin trading today after its IPO yesterday, but ended up pulling its IPO after all. At the very same time, the Securities and Exchange Commission is investigating the interplay between high-frequency trading firms and computer-driven exchanges like Bats. Bats' troubles today may refocus scrutiny on modern economic market structure. For more on how today's trades went down, let's bring in our senior markets correspondent, Julie Hyman in New York. Julie, explain what happened today.
And it does take some explanation because it was a very strange day, unprecedented day of first trading is what many folks were calling it. And it first started not with Bats at all, but with Apple, as you mentioned. So let's go through sort of a timeline of what exactly happened. All these times are Eastern, by the way, New York time. 10:57, that Apple circuit breaker was tripped after the stock fell to as low as 542.80. That was a big plunge, and it was just a single block of 100 shares. Then it was halted by 11:02. It had resumed trading at really little changed at 598.11. Then attention turned to Bats. That's because Bats said it was experiencing technical difficulties in tickers between A and BF, which included Bats itself. It was supposed to begin trading for the first time. This was supposed to be the first listing, primary listing on its own exchange. Other stocks trade there, but they were not listed there, at least until today. So the first trade, as you can see, crossed at $15.25. The shares were sold to the public at $16. So, you know, a little bit of a drop, but not that big of a difference. But then at just a few milliseconds even after that first trade crossed, we saw the stock plunge of Bats. And what a plunge it was, all down to almost 0.0002 cents to be exact. So you can't get much lower than that. By 11:29, however, the firm had said that those trades would be canceled. Anything between 11:14 and 11:15 would be canceled. By 12:06, the company said the trading in its stock would be halted until further notice. And then things got even more interesting by the afternoon here in New York. Bats said a little after 3 p.m. that the shares would not open at all today. And finally, a little bit later, it withdrew its IPO entirely. So we're not even sure that it will even still go through at any point with this initial public offering. Certainly, it has been suspended until further notice. So everybody on Wall Street's been scratching their heads today saying, what happened here? A lot of the various exchanges do experience technical difficulties from time to time, but just the sheer coincidence of it happening on the same day that the company was supposed to be going public is really causing a lot of confusion, Emily.
Right. A very bad coincidence, if indeed it was truly all coincidental. Thanks for that, our Bloomberg Markets reporter, Julie Hyman in New York. Now, joining me from San Diego to talk more about how technology is changing the way markets work and the risks that come with it is Bloomberg contributing editor Paul Kedrosky, a longtime tech investor and the author of the blog Infectious Greed. Paul, welcome back. As always, one of the more wild theories out there today is that some kind of hack attack happened here, and that's how this all went down. Francis Gaskins of IPO Desktop suggesting that as a possibility. What's your take on that?
You know, I mean, it's possible. It could have also been me coming back from skiing a day early. But I mean, I think in these cases, you have to go for the simplest explanations. Like this sort of thing, this kind of air pocket, as all the high-frequency firms withdraw at once from market making. We've seen these flash crashes before, and this is really what this looked like more than anything else. It doesn't require hacking. It's an example of how the microstructure of the market, the very way that stocks trade, using high-frequency traders as market makers, and the way the technology works, is so susceptible to this sort of thing, where simultaneously everyone withdraws from the market at once in this kind of interlocking way, and liquidity goes from vast to zero in milliseconds, and that's exactly what we saw. No hacking required.
And you point out high-frequency trading is actually involving an arms race now, a technology arms race. What exactly do you mean by that?
Yeah, I mean, so if you think about what's going on here, you're having these legions of new firms who trade incredibly, violently, actively, frequently, all the time, who are, really supplanting the role of market makers in the market. And the way that they do it, of course, is by trading very frequently, which requires them to have very fast connections. So they're constantly building up the speed of their connections, the pace at which they can trade. So that if you think about it in terms of computer terms, the speed of those computers. And even, as we've seen over the last few years, moving their trading stations closer and closer to exchanges themselves, because the co-location, which is what this is really called, becomes important, because even things like the speed of light can become a binding constraint. So you don't want to have too much room between you and whatever the primary trading venue is. So this arms race is, I like to describe it as, it's exciting and it's interesting all on its own, but in a way, Wall Street's kind of doing the rest of us a favor, which is it's kind of an advanced R&D lab for what the cloud economy could end up looking like if we're not thoughtful about how we design for the inevitable high-frequency trading of physical goods in terms of buying and selling around the world on cloud services. Because this is what Wall Street's really showing us. It's showing us what happens. These sort of interlocking trading systems trying to do things at very, very high speeds are prone to these fantastic crashes.
And also putting pressure on normal cloud services. Paul Kedrosky, Bloomberg contributing editor, we can always rely on you to break it down. Thanks so much for joining us.
See you, Emily.